All right, welcome to the Explainer. Today we're cutting right through the noise to look at the structural architecture of tax strategy. We're going to break down some anonymous expert reports to reveal the actual mechanisms, the real cause and effect systems that successful business operators use to legally preserve their capital. There's absolutely no fluff here, just the blueprint. So let's get started.
Here's our structural mat for today's analysis. We'll start with strategic entity architecture, move into income bifurcation mechanisms, then hit real estate loss classification, advanced cost recovery tactics, updated statutory reporting thresholds, and finally wrap up with qualified production property allowances. Let's dive into Section 1, Strategic Entity Architecture, Foundational Legal Frameworks.
Okay, so let's start with the absolute cornerstone here, the pass-through entity. Put simply, this is a legal structure where your income totally bypasses that dreaded corporate-level double taxation. Instead, it routes directly to the individual operator's personal tax return. This single mechanism is basically what makes specialized loss classification and all that deduction engineering possible down the line. It's an absolute game changer. The implicit assumption in the tax code is actually pretty straightforward. Your structural choice dictates your liability and your routing. Statutory rules distinctly separate corporate entities from these pass-through structures. Basically, the entire rulebook governing exactly how your income and deductions flow changes completely depending on which bucket your entity falls into.
Now, expert reports often refer to the ideal setup as a T-formation architecture. It's a literal structural map for managing risk and wealth. Think of it like a giant puzzle. Down at the base, you've got a trust anchoring the whole system for legacy planning. Over on the left side, your operational entities handle the active income and absorb the daily risk. And on the right side, holding entities quietly own your passive assets, like real estate. The genius here is isolation, right? Active risk is legally completely walled off from your passive assets. Moving right along to Section 2, Income Bifurcation Mechanisms, Operational Deductions.
Right, so here is a crucial contrast in default tax treatments. Standard self-employment income, well, that's universally subject to self-employment taxes. But by strategically using a specific corporate election, like an S-Corporation, for example, an operator can split their income. You legally separate a quote-unquote reasonable salary from your remaining profit distributions. So why does this income split matter so much? It all comes down to one number, 15.3%. That is the standard statutory self-employment tax rate. By splitting your income, the profit distribution portion completely bypasses this 15.3% tax. It's a highly effective cause and effect relationship. You just change the structural classification of the income, and boom, you legally eliminate a massive percentage of the tax burden on a very significant chunk of your operating profits.
Let's jump to Section 3, Real Estate Loss Classification, Reclassifying Passive Losses.
Here is the step-by-step statutory loophole to completely break that passive limitation. First off, the asset has to be operated as a short-term rental. And strictly speaking, that means an average guest stay of under 7 days. Second, the operator must log over 100 hours of material participation, and crucially, more hours than anyone else involved. The result? Those previously trapped passive losses are mechanically reclassified as active. This means they can directly offset your high W-2 salaries or business profits. Section 4. Advanced cost recovery tactics, accelerating deductions. You know, a cost segregation study is just a fascinating analytical breakdown. It doesn't treat a building as one giant single object. Instead, it separates structural components from non-structural items like fixtures, appliances, or flooring. By reassigning these items, analysts can apply highly accelerated 5, 7, or 15-year depreciation schedules instead of the standard 39 years. What you're essentially doing is pulling massive, front-loaded deductions entirely into your first year of ownership. It is incredibly powerful.
All right, Section 5, Updated Statutory Reporting Thresholds, Macro Regulatory Shifts. Okay, there's a really interesting statutory dichotomy here that operators absolutely need to catch. For third-party network transactions, the 1099-K reporting threshold retroactively reverted to a much higher $20,000 gross payment limit, assuming you have over 200 transactions. Conversely, looking ahead to 2026, the threshold for non-employee compensation is set to increase from its historical baseline to a new $2,000 minimum. Tracking these precise thresholds is absolutely vital for keeping your accounting systems compliant. And that brings us to Section 6, Qualified Production Property Allowances, Specialized Statutory Provisions. Consider the highly specialized elective provision for qualified production property, or QPP for short. The criteria here are exceptionally strict. The property must be placed in service between July 2025 and December 2030, and it has to be integral to manufacturing, agricultural, or chemical production. Crucially, if you lease this property to a third-party operator, the allowance is completely invalidated. There's no way around it. It's an incentive that is strictly reserved for active production. Now, there is a super granular level of optimization available here through the elective stabilization of earnings reporting. Official guidelines outline optional net earnings calculation methods for both farm and non-farm income. When your actual net earnings dip below certain benchmarks, operators can elect to utilize calculated thresholds. This lets you strategically optimize your reportable income, ensuring you maintain eligibility for statutory benefits even during lean periods. It's essentially a brilliant safety net.
Which brings us to our final thought. We've just explored the cause and effect mechanisms of entity isolation, income bifurcation, loss reclassification, and cost recovery. The definitive takeaway here is that tax efficiency is a deliberately engineered outcome. It is definitely not an accident. So I leave you with this. Are your entity structures proactively engineered to capture these statutory mechanisms, or are you passively leaking capital? Thank you so much for joining me for this explainer. Keep optimizing, and I'll see you next time.